Hi guys, hope you're doing well. This is HTrade and this is day 2 of trading the 50,000 evaluation for Funded Next. Alright, so I'm just going to quickly do a top-down analysis on NQ. So after my trade yesterday, I took a beautiful sell. Well, you won't see it now because I'm on the weekly time frame. But nevertheless, I took a beautiful sell, I took my profit and I'm done for the day. Right, so that's during New York session open. All right, so I would just like to do a top-down analysis because I want to put your guys' attention to what actually happened, what's actually happening on the weekly right now, and why it's happening, right? So besides the news, people waiting for rate cuts, etc., etc. At the end of the day, trading is still a probability game, right? A probability game. It's not a certainty. It's a probability game. So we must respect our history, what the history did, and why the history did what it did, the history of the flow of the market, right? Now, the sure thing, or not the sure thing, but regarding probability when it comes to price moving the way it does, you can have a look at what it did in the past and where it reacted from. Which areas did price react from the strongest, right? So let's start from the monthly, right? We were bullish in August, we were bullish in September, we were bullish in October, and now we were bearish so far in November. We are always at the end of November, but what happened during November? A lot of news regarding the government shutdown, right? And now the government, since the government shutdown is basically over, you see we started going bullish again, right? And there was news regarding rate cuts, etc. So besides that, you always get two sides of the market, right? You get the technical aspect and they get the fundamental aspect. The technical aspect is the technicals that what price movements you can physically see on the market. The fundamental aspect is the news, right? The news is something that's tangible, something that can change whenever it likes, actually. And you get red folder news that gets posted on a regular basis. Then you can see, all right, so there is a red folder news event that's going to affect the US dollar currency. That's also going to affect the NAS 100 or gold or S&P 500 or US 30, etc., etc. Now, in this case, I'm putting my focus on NQ, which is NAS 100. So on the monthly time frame, now I'm talking now about fundamentals and technicals, right? So now we are literally focusing on the technical aspect, right? What regarding the technical aspect are we focusing on? So let's go top-down analysis. I like to put my focus on the fair value gap, right? Fair value gaps, because those are very big areas of liquidity. So it's gaps made in the market. What is a fair value gap? A fair value gap is basically a gap that's created between three candles in the middle of the second candle, between the areas of the wicks of the first and the third candle. So basically inside the body of the second candle, that's where the gap lies, right? So in this case, the gap lies between this wick of the first candle, you see right there, and the gap of the third candle's wick there. Now, if this wick went through here, then there would not have been a fair value gap like here. Like we had a bullish candle, we had a bullish candle, we had a bullish candle. So this wick and this wick went through, completely through the body of the second candle. So there's no gap. Here is another example of a beautiful fair value gap. First candle, wick, stopped there. Second candle moved up with a lot of volume. Third candle started moving up further, leaving a gap in the middle of the body of the second candle. All right, so let's move on. So monthly, yes, we were bearish, but what did we tap? We took the liquidity of this monthly fair value gap. What happened after that? To have a look at that, we go down to the weekly time frame, and we tapped that monthly fair value gap, and lo and behold, we got a massive reaction of that monthly fair value gap. All right, so we not only that, we also had a reaction of of 2 weekly fair value gaps. Weekly fair value gap number 1, weekly fair value gap number 2, right? And now from the top we have a weekly inverted fair value gap. That's why I'm saying the weekly time frame is not bullish just yet. So why do I say that the weekly time frame is currently not bullish? It's bearish, right? So why do I say the weekly is bearish? Because we made a weekly fair value gap. Could be here, it could be here, but you see no wick of that candle, right? So we stretch it over, we broke and closed below this weekly fair value gap, and now we're tapping that weekly fair value gap. All right, so very big confluence of what? So when we tap an inverted fair value gap, there's a possibility of a reaction in the opposite direction. Now, normal fair value gaps are great indicators of a continuation of order flow, or of the flow of the market at that point in time, right? An inverted fair value gap is basically a fair value gap that's not being respected. Not only wicked through, but closed below it, right? Closed below. So now, instead of being a weekly fair value gap, at this point, now it's an inverted fair value gap, signaling that the weekly time frame is now at this point bearish. So some say it's bullish, some say it's bearish, etc., etc. I don't really care. I follow the market in my way of handling the market myself, right? So weekly is bearish, monthly is still bullish actually. It's not bearish, it's bullish. So let's go down to the daily time frame. I love this fair value gap indicator, because if there was no fair value gap indicator showing this one as a green candle, I wouldn't have seen this new daily fair value gap that's been created. So here you can clearly see we are tapping the weekly inverted fair value gap, right? So we are bound to have some form of reaction here to push price down into back down. Whoa, well, I don't know what's going to happen, but this is just my theory. Remember, trading is always a probability game. There are no certainties in the market. The only certainties in the market, believe it or not, is what? That you will lose money. That is a certainty. That's actually the only certainty in this market. You will lose money. Now, that's the only certainty and negative. But how you handle that negative is going to decide, are you going to be profitable in the market or not, right? So in any case, let's go down to you're on the daily, right? So price went down, reacted from this monthly fair value gap, weekly fair value gap. We went up. Now we are bouncing off what? The weekly inverted fair value gap. But what are we also bouncing off? What do you see here on the left-hand side? Besides this new daily fair value gap, what do you also see? We also see a inverted daily fair value gap. Let's zoom in. All right, so let's just put the weekly inverted fair value gap more to that side. So what do we see here? Inverted daily fair value gap. Perfect. What do we also have? We have a bearish fair value gap. This is why I sold that day specifically, I sold very hard here when this happened. Okay, price went down, price went up, created a bullish fair value gap. We almost tapped that bearish fair value gap there, almost. So the price took the daily liquidity of this day, this day, this day, this day, and started going down, creating a daily inverted fair value gap here. We tapped, we made a new normal daily fair value gap. We tapped this daily fair value gap and price started going down. Great. Beautiful confluences for a sell. Beautiful. We tapped this weekly fair value gap. We had a reaction. We took this daily liquidity. You see that candle wick. The wick of the daily candles are always good areas of liquidity. And price started going up and down. This is a Thursday. All right. So price went up, took some more liquidity, tapped what? What did we tap? You see this? Daily fair value gap, and went down. But we didn't only tap a daily fair value gap. If you draw a fib, this is now the first time that I'm going to use the fib to show you guys why I love the Fibonacci tool. Draw a fib from the nearest high to the nearest low here. Actually, at that day, price weren't here yet, but it's more to the end of the day when it started going down, crashed down hard. So that was the nearest low at that point in time, right? So now let me show you something. I'm gonna extend the fib. So what did price do? Price went down, price went up, tapped the what? Level of the fib. Remember, bigger institutions out there, much bigger than normal retail traders like me and you, right? So you can trade ICT to your heart's content. You are still a retail trader. I don't know if you want to hear it or you need to hear it. If normal guys like me and you, I'm not speaking about the normal guys, not the bigger companies out there. I'm the normal guys, just the everyday guy that's sitting from home, trading from home, trading from an office. I don't care, right? So if you are managing your own capital, you are still a retail trader. If you're trading your own capital as a normal guy, you're a retail trader. If you are trading a hedge fund, on the other hand, yes, then I would say, all right, cool. Or if you're trading much more people's capital, or if you are basically trading with the banks or the bigger financial institutions, yes, you're a big trader. You're a big guy, right? But the normal guys, they're just trying to make ends meet, trading their own capital. We are retail traders. That's it. That's the reality of things, right? Any case, long story short, bigger institutions out there make use of the Fibonacci tool because the top part of the Fibonacci tool. So if you are in a downtrend, as we clearly are, they always want to sell in premium. What is premium? Premium is the top 50% of the Fibonacci tool. And discount is the bottom 50% of the Fibonacci tool. So that's why I love the Fibonacci tool, especially on higher time frames. You see? All right, so I've proven my point here, basically, by just showing what the market did. So this is not made up nonsense. Now, cool. Price and reaction. Tap into this weekly fair value gap, monthly fair value gap, started going up. Beautiful, right? Where are we? Where are we right now? You see this? We are already close to this dangerous inverted fair value gap area. We're already tapping the weekly inverted fair value gap, but we need more liquidity to have a bigger reaction from it. And my best guess is price is going to tap this area here. Right there. Take this liquidity, tapping this daily fair value gap, or even tapping this area here before started having a bearish reaction to at least the start of the daily candle, or if it has a very big reaction, it might go into this area right. So either here or either, let's just do this. I mean, really, come now. Here, which is the new daily fair value gap that was created here. And this is the only thing that you can say. You can't go further than this at this point in time because I'm trading on the daily. I'm a day trader. I do trades on a daily basis. So I don't expect much more from the market than this on the daily. I won't even go to the 4 hour. Why not? Because I use the 4 hour for daily confluences when I trade. So the 4 hour can change in literally one single candle. The daily, on the other hand, you have a broader idea of where the liquidity is. Let me just quickly give you one last piece of advice. Where is the biggest forms of liquidity? Daily highs, daily lows. Why? Let me give you, you can literally see this. Why? Let me show you here. Price went up. Next day, price went down. Took some more of this liquidity. Right? But ended bullish, right? So next day, price took out the previous daily high, went down to at least 50% of that daily and ended up bullish. Next day, price took out this liquidity. Let me use this. Let me use this to show you guys what I mean. Took that daily liquidity, went down and took the previous day, the bottom of that daily wick, took this liquidity, and we started tapping this daily fair value gap. And now price is having a reaction here. Price started having a reaction here. Went up, had a reaction of this. Liquidity, started selling again, right? Next day, what happened? Price started here. Went up, took what liquidity? Took the previous day's liquidity and ended up here in the middle. Next day, what happened? Price started here, went down, taking this liquidity, this liquidity, this liquidity, and closed below, almost below this the daily fair value gap, turning this now into an inverted fair value gap. Next day, what happened? Took this liquidity here, tapped into this daily fair value gap for extra liquidity, went up. Now price left a new daily fair value gap. Now, since there is a new daily inverted fair value gap and a daily bearish fair value gap, that's where price started going downwards. So, an inverted fair value gap and a new fair value gap combination like this, that is my signal telling me that whatever time frame I'm currently in, there's a possibility price is going to start reversing because there's an inverted fair value gap and a new fair value gap in that direction, right? In any case, next day, price took out this liquidity, sold off, and took a lot of this liquidity and a little bit of that liquidity, right? So now we're ending here, right? So what happened here? Price took this liquidity, went up a little bit, and sold off, taking out this liquidity, and some of this liquidity, right? Price started going up. Where did price go up into? The previous day's liquidity. And also what? This daily inverted fair value gap. Right? Cool. Cool. Etc. Etc. So basically, now taking this liquidity, price sold off. Taking this liquidity again that week. Again, price sold off into this week, this daily week. Next day, we partially took off this, take part of this liquidity here, started selling off into this liquidity here. So price literally moves from one point of liquidity to another. So that is what price do. It takes liquidity and run. Take liquidity, run. Take liquidity, run. Take liquidity, run. Take this liquidity, run up. Take this liquidity and some of this liquidity, run down again. Take this liquidity, goes up. Now here, that was the start of the new week. So there's a new week opening gap. So this is also a point of liquidity. So we tapped into this liquidity. If I can go down to the 1 hour time frame, I'll show you price tapped into that new week opening gap and started going up. And then we ended up tapping this liquidity here. So the biggest forms of liquidity for me is on the higher time frame. Fair value gaps and inverted fair value gaps. So yeah. Anyways, I'm going to stop here quickly and then I'll take a look later on if this, what's happening with this movement here to see if we're going to have a reaction of this area here. Like I said, trading is a probability game. So let's see what happens next. So I'll just do my analysis again later.